If you guys are trading with no framework, you are literally trading blind. And in this video, I'm going to be covering my full R8 continuation model from the top to the very bottom. So let's get into it. We have a full Morrow board that we're going to be jumping through. So this is going to be pretty beginner based. So if you are advanced or intermediate, you can skip to when we're on the charts. However, if you go through this whole video, it's going to be the best for your development. So let's get into it. So this is my R8 continuation model, the full framework. All right. So why do most traders fail? We just got to point this down to the top 3 traits of failing traders. And this is going to be revenge trading, no trading plan, and no risk management plan, right? So this is the most common thing I see in most of my students that come through is a revenge trade. After they lose one trade, they just double their risk and they go in harder than ever before. They lose their accounts and it's just an endless loop. They don't have a trading plan. They can't even tell me their actual model off by heart at all. So it just doesn't make sense, right? Because you're not trading a plan. You're trading off of hope and you're just gambling at that point. And you just don't even have a risk management plan. You don't know how much you're risking. You just come into the markets and hope. So what's the result of this is you just end up quitting. And the loop of failing in trading looks a little bit like this. So you have no trading plan, and then basically you develop unprofitable habits like strategy hopping, taking signals, copying trades. You end up watching live traders. You just copy their trades. You join, Telegram groups, copy their trades as well. You backtest a strategy for one day. You get a 50% win rate, and then you literally just go and hop to the next strategy. And this is just an endless loop. And then you get no results, and then you just go straight back to the start, and then you come back to strategy hopping, taking signals. And before you know it, months and years have gone past and you've done nothing about it. So what is the actual fix to all of this? So this is actually what you need. You need a strategy that's something that makes money. Okay, that is the bare bone, is you need actually a strategy that makes money. So something that's proven by data. That's the number one thing. Number 2, you need risk management, right? So the bad days in trading don't actually take you out. So what this means is if you have, let's say, 2 times winning, 2 times losing days, you don't actually lose your account because you have that risk management plan. You have your daily lockout set. You need this. And then you need consistency and discipline. Same setups every day. So not a 1A plus week and then a Z grade the next week, right? So you're always trading on consistency and discipline. Now, I want to jump into actually how the market moves. All right. So how does the market actually move? So it's a power of 3. Okay. Accumulation, manipulation, distribution, right? So in accumulation, the market consolidates. Buyers and sellers are getting trapped, right? You don't really want to trade in this phase because the market kind of looks like this. So let me just put these back and we'll bring this over. So the market kind of just looks like this. So let me just draw out some accumulation. So we're just accumulating orders, right? So when buyers push it up, the sellers push it back down. We're just accumulating orders at this time, right? Then we have the manipulation phase. This is the fake out. So you can actually trade this. However, when you're a beginner or intermediate, even advanced, it's easier trading the distribution phase. We'll get into that. So the manipulation phase is where most people lose their money because they think this is where the move is starting when it's simply not. So if we come over here, what happens is the market pulls up, right? Like this. It takes out everyone's orders here. All these guys think we're going higher. So they buy in and then the market just goes like this. So this is accumulation, manipulation, and then this right here is a distribution. So the market starts distributing to its actual draw that it wanted to go to in the first place. So this is the real move, and this is what you actually want to catch. And this is in continuation, the best and easiest thing to catch because you are trading the distribution most of the time. So what is continuation trading? So let's define this. You trade with existing momentum, right? So as you can see, we are making higher highs, higher lows, higher highs, higher lows, higher high. So the market is moving with a trend, right? Making high highs, high lows, high highs, high lows. And the same thing with the downtrend. Lower lows, lower highs, lower lows, lower highs, just like this. So it's both. You can trade this in both directions. You don't need to just trade this with uptrends. So the whole point is you don't fight strong moves. You literally just ride with them. You just ride with the wave. If you've ever been at a beach, you don't try push yourself through the wave. You either ride it back into you ride it back into land, or you jump under it, right? You don't try fight that wave because it's just not going to work. So in continuation moves, there's a bullish trend, high highs, high lows, high highs, okay, just like I said before, right? And this is kind of how it looks. Price taps into a fair value gap, it displaces, the displacing candle closes above, and the move continues. Okay, so that's what it looks like. And I've got a trade example right here that I will show you. So, as you can see, prices come up here, right? And let's just mark this out as we go. See how the market makes a high? It pulls back into a fair value gap. The fair value gap is here. I'm going to draw it out. See that from this low to this high? This is the fair value gap. The market brings itself back into here, rebalances, makes a new high. So you see, just like before, I'm drawing this out. I'm drawing this out on a just a line chart. So this is what that exactly looks like. Bang. So you can see it's just an uptrend. That's all it is. And it's using fair value gaps to move higher. Now, same on a downtrend in this example. The market displaces down, retraces, displaces, it retraces, displaces, retraces, displaces, accumulates for a little bit, displaces, retrace, displace. So that's what it literally looks like. So as you can see, the market uses fair value gaps to distribute into the direction of the draw on liquidity in that trade. So this is a really nice example of showing that. Now, I want to go over internal, external range. So obviously when we go to the charts, I'm going to show this as well, but it basically goes external, internal, external, internal. That's how it works. So as you can see in this chart, right, we displace, and then this move coming up here, so this move here goes to internal liquidity, which is fair value gaps. And then this move here is external because it's taking the external liquidity. So I'm going to read this out. Displacement down, right? Internal, external, internal, external, internal, external, internal, external, internal, external. Right? Same with here, right? External, internal, external, internal, external, internal, external. That's how it works. So you can read that out when you look at the charts, and it's basically just rebalancing each time it takes a new high or low before continuing the trend. I hope that makes sense. That was one of the biggest things in my trading that really helped me was internal, external. So liquidity, where price is actually headed, right? What is liquidity? Liquidity is resting stop losses in the market. All right. So when you put your stop loss in the market, you are liquidity. That is the liquidity point in the market. And price moves towards liquidity. It sweeps it and then reverses or continues. All right. It's very simple. That's what it does. So if you look at, let's say right here, this is just an uptrend. There is liquidity here, 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 and here, right? So let's say this is an uptrend right here. Now, once price is displacing high, the liquidity in this is here and here. So the market can either go bang, take out the stop losses here, or it can go bang, take out the stop losses here. And that's liquidity, and that's how it moves. So we're going to get into session liquidity. Okay, so you have Asia high low, you have London high low, then you have New York AM high low, and then New York PM high low. That's what it basically, that's how it transitions, and it basically just repeats itself. So it goes through it, back, around, and just continues. So if you trade New York AM session, you usually have London high and Asia high to target, or London low. Sometimes a session high or low is already taken. So New York AM pre-market could have taken London high, but then you still have Asia high intact. So you can basically, whatever session you're trading, so let's say you're trading London session, you can normally target Asia high or low as a draw on liquidity. So you can trade to that. If you're trading New York PM, you might have a New York AM high or low to target. You might have all of them. You just don't know. It always changes. So whatever session you're trading, you usually can target previous sessions in that trading session. So one of my other really big draws on liquidity is going to be unfilled high time frame gaps. This is my favorite draw on liquidity. I say this all the time. I always love to check for unfilled gaps, hourly unfilled gaps, 4-hour unfilled gaps, and daily unfilled gaps. Dailies don't happen as often. I would say the most common 1-hour gaps, of course. It's gonna, like, the lower the time frame, the more it's gonna like appear, of course. But these are really nice. So I actually prefer, usually if you have like an unfilled 1-hour or 4-hour gap, it's actually usually sometimes stacked in with, let's say, a London high or an Asia high or Asia low. So if you have like a Asia low and it's also a 1-hour gap unfilled, that's insane. You have a really good draw on liquidity. That's going to be a great targeting price. So coming into a session, always check that. Okay, that's going to be your number one. So we're going to be going through the R8 model now and the actual 4-step framework that I use every single day coming into the market. So this is the 4 steps. Number 1 is you're going to find the draw on liquidity like I talked about before. You're going to go in the session. If you're trading New York AM, you're going to come in the session around, let's say, 9:15 AM, right? And then you're going to search for sessions, highs and lows. It can even be New York PM at that time because New York PM's all the way back here, right? So you can, usually it's probably swept by then, but sometimes it's not. And then you're going to find any unfilled gaps. If there's no unfilled gaps, you can just use sessions as well. So you're going to find your DOL, and then basically after market opens, you wait for the market opens, and then you wait for a price to displace, right, toward the draw. So let's just draw this out. Let's say the chart's like this, right? Displacing. Let's just say the market. Let's just draw this out. So let's say this here is London high and this is Asia high. So price is clearly displacing towards the draw here, right? Then we're going to wait for so we've got this, and then we wait for a retracement. So we have an FVG marked out here. This is going to be your condition. You wait for price to tap back into this gap, and then you want to enter on displacement or IFVG. I don't know why it says IFG. I must have messed that up. And then it displaces out. You can take the IFVG entry. This means it inverses a fair value gap, or you can, if there's no gap, you can take the displacement entry. You can enter here, stops at this low, take profit even at this high, or take profit at that high here. So that's kind of what it looks like on the actual chart. However, we're going to get into that later a little bit more. So find your DOL. We'll just go over it one more time. All right, so find your DOL, mark your target, a session high low, high time frame gap, or a structured high low. So low resistance liquidity for this instance. You wait for a displacing candle, which confirms price is moving to towards your draw, a strong displacing candle, not just drifting. You want to make sure it's actually like a strong push. All right. Make sure you wait for that retracement in price into a fair value gap, so you are not entering early. You enter, and then the price retraces on you. So make sure you let it retrace into a 5-minute, 1-minute, or 30-second FVG. This protects you from entering right before a pullback. Very key. Okay. Now you enter on displacement or IFG. I don't know why it all has IFG. I don't know why, but it does. Enter once price displaces out of the retracement zone or inverses the gap, okay, in your favor. Very simple. Now, let's get into entry framework. Displacement entry. This is basically what it looks like. So you have your DOL marked, displacement candle, you retrace into an FVG, entry on the break, stop at the low, target at the DOL. All right. And then here you have your DOL marked, displacing candle towards a draw, and then you go retrace into an FVG. You enter on the IFVG, stop at the swing low, target the draw on liquidity. All right. So with every framework, there's rules. There is rules with every framework. Always check the higher time frame first. Don't trade on the lower time frame blind. Okay. A lot of people trade on the 1 minute time frame and don't even check the higher time frame. This is super dangerous because you don't know where you are on the higher time frame. The higher time frame is king. All right. So don't trade on the lower time frame without checking the higher time frame, because the higher time frame holds the real narrative. Now, risk management guide. All right. So $500 risk per trade on 50K accounts. If you have a larger account, you can increase this, or if you have a higher risk tolerance, you can increase this to, let's say, $1,000. Okay. So you can change it to 1K if you would like. Max 1-2 trades a day, only A+ setups. This is what everyone tells you, but like, this is all you can do. Now, keeping going down here, the risk keeps you in the game. All right, you can't score from the sidelines. Over risking on bad trades takes you out of the game entirely, like fouling out in basketball. There's no point fouling out of a basketball game. You may as well, when you're on that last foul, you may as well just play it safe and let him go to that layup, Okay. So discretion and data. How is actual discretion built? So when I talk about discretion, if you've watched any of my previous videos, discretion is time in the market, and you can't pay for this. It is just turning up to the charts every single day and learning how the market moves, learning the session you want to trade. So a lot of people go, like, I actually got a comment after my trade last night. He said, how did you know that the market was going to resweep? So the market was rebalancing. So it looked like this. We had a fair value gap to rebalance into. The market opened, swept it, and displaced down. I didn't enter here, right? I didn't enter here. I waited for the resweep and then I entered, right? And my student asked me, how did you know the market was going to resweep? And the thing is, I didn't know anything. It was just that my discretion told me to wait, okay? Because I've had time in the market. And I've taken that first trade so many times to recognize the pattern, okay? And just plus consistent data collection. I have multiple trades inside my journal that look the same. So when I see that trade, I enter because I've seen it before. Okay. Now, this is the real example. Time of day win rate. I have collected my own data and I know, right, before 9:37, my win rate's 92%. I took a trade at 9:32 last night, basically 2 minutes into market open, and the trade took about 30 seconds to win. After 10 a.m., my win rate drops dramatically. And I only know this because I've backed it with my own journal data. So you guys have to collect data for yourself, because your trading is going to be different to mine, and my trading is going to be different to yours. So you have to collect data so you know these stats. So I always just enter the time I enter and time I exit. And I've also noticed the trades that I'm in for longer, like the longer I'm in the trade, the worse it is. The quicker the trade goes, the better. So the best times to actually trade is, especially if you're an Australian, most people are going to go to this London session. The best macro for this is the 250-310. So I usually just trade, if I'm doing London session, 3 a.m. EST. And you're going to grab that macro, you're going to get that open time. And if you can't make this macro, then you can start the earlier kill zone open, which is 2 a.m. Okay, so 2 a.m. EST, this is all in New York time. Now, if you want to trade the New York session, then you can do the main macro, which is 9:45 to 10:15. Okay, and if you want to stay up a little bit longer, which it's hard for Australians because, of course, like, it's hard staying up a little bit longer. You can trade the 1050 to 1110. This is secondary because this is going off like the 10 a.m. reversal / continuation model, okay? So the main one you're going to be focusing on for New York AM is going to be the first 9:30 to 10:30, okay? If you want to stay up longer, this is for you. So what kills traders? What actually kills traders? The 3 top biggest mistakes that I see is taking signals. This is the biggest one, and it's something I've recently stopped. Is I was live trading. I've stopped this completely now because it's just actually, well, I was technically under this copy and trade. So taking signals, this is like signing up for a Telegram group, or, you know, if you're inside a Discord that sends out trades and says enter now, stop loss here, take profit here. Most of these guys are scams, and they're literally just taking your money on a monthly occurrence. You're just buying into a dream that you can turn up and just take someone else's trades, make a lot of money, and be on a beach somewhere and not have to think. It's just not it. It's not it. And even if it's a legit, right? Even if it's legit, it actually teaches you nothing. It teaches you nothing. You're literally relying on someone else. You're like a little baby, okay? Relying on someone else. Now, the next one is going to be copying trades. You can never learn to read the market yourself. And this is what I was doing with my students. I was live trading and I wanted to teach them. However, people were copying me. And they're just not going to learn to read the market for themselves. So this is the next biggest thing. If you're inside a Discord and you're copying trades, please stop. This is not going to help you. This is going to actually push you further away. I'm telling you now. When whoever you're watching enters the market, you're going to know they've entered probably 3 or 4 seconds later. After they click the button, they'll go, yep, I'm in. So then you're going to go press the button. You've got in 7, 8 seconds later, and you already got a worse fill. And how many times, if you are copying trades that you've entered and the person that you're watching has gone break even and you can't even go break even, or they've taken profit and you've gone break even, it makes you mad. And this is just one of the biggest mistakes. This is probably the biggest mistake I see in traders. Now, the next one is going to be strategy hopping. Okay, so one bad backtest and the traders abandon a working model because they would have actually learned it if they stuck with it, but they just abandoned it because they had one bad trading session on a backtesting session. So I've had this too. Like, I've gone in backtesting and I have like a 40% win rate in like a couple of weeks. So I'm like, what is going on? Like, I can't hit anything. And then some months I'm like 94% win rate, and it's just really easy to trade. So you have to remember that you have to stick with one strategy. Whatever makes sense to you, stick with that, and that's going to work the best for you. Okay? Or pick a strategy that someone knows that works, the R8 model, and stick with it. So the whole goal of this, right? The real goal of trading, not one good week, it's executing on high quality setups consistently. All right? Weekly goal system. Pick one and focus on one area per week. All right. So week 1, trade quality. Week 2, risk management. Okay. So actually set up a weekly goal system to get where you want to be. Right. If this is, let's say, writing down in a journal. Okay. This week I want to take the best setups I possibly can. And if I lose, I'm going to journal and reflect on it. Do that. Next week, you should be doing that plus something else. This week, I'm going to really work on getting my contract sizing right, risk management. All right, so this is going to be a full draw and liquidity checklist. This is what I look for every single session. So have this written out. So daily, 4-hour, 1-hour fair value gaps. You can also add in 15-minute fair value gaps as well. So add in 15-minute fair value gaps as well for unfilled. Session highs and lows. New week opening gaps, new day opening gaps as well. So NDOGs or NWOGs, and 1 hour highs and lows, and 1 hour and 4 hour highs and lows. Okay. Which usually are session highs and lows anyway, or daily unfilled fair value gaps or 4-hour fair value gaps unfilled. Okay. So with all that, I'm going to take you guys through a live walkthrough of actually how to trade this, going through a pre-market checklist. All right, guys, so we're going to get into some examples here. We're just going to start on a non-real life chart example. So this is just something I drew out, and we're going to go over the analysis of this. Okay, so as you can see, the market has come up, made a new high, and then it's making lower highs, right? Lower highs, lower lows. So this is a downtrend. Now, as you can see in this example, the price has swept out liquidity to the left. So swept out a low with this, okay? So you would call this a liquidity sweep, right? And then as you can see with this leg up, we've made a new high, all right? So we haven't continued the trend and made a lower high and continued back down. We've made a new high. So what I see when I see the market do this is, okay, the market has made a new high. It's probably going to seek out the draws on liquidity in being these highs right here. So you can initiate the price rebalancing into, let's say, a fair value gap. So you can see inside this leg, we have a fair value gap here. The market wants to rebalance into internal liquidity, and then it wants to go back to external, which is this high here, and seek out the external draws. So we'll just go through this. This is going to be external, okay? This is internal. So this is internal liquidity of this leg right here, because this is going back into internal, right? If the market goes back up and takes this high, that's going back to external. However, the market has gone into this imbalance. So this could be a fair value gap, and this is internal, okay? Internal. Then once the market's made a new low and taken out this low here, that's external, right? And after the market takes external liquidity, it goes back to internal liquidity. All right, then it goes to external, so it's taken out external liquidity. And what happens after price takes external liquidity is it goes back and seeks internal liquidity. So it could be a fair value gap inside this leg. It could be equilibrium of this leg right here. So price seeks equilibrium. Now price could easily just want to tap equilibrium and then keep going on the downtrend. Or when you see price, let's say, disrespect it and make a new high, then you can say, okay, well, price clearly wants to seek out some liquidity in these highs here. There could be an unfilled fair value gap here on a higher time frame, a daily fair value gap. So let's say this high right here could be a unfilled 4-hour gap that the price just swept the low. Now it wants to go sweep into a high time frame gap and then continue lower. So you've got to understand higher time frame structure. And it's very important to understand how the market moves on higher time frames. So before we get into some real-time live examples, we'll just go on the lower higher time frame here, and we'll see how the market moves on the higher time frame. So we'll start over here. Okay. So as you can see, the market will start on the really high time frame. So weekly, this is the weekly chart. As you can see, price displaced up, and then we started getting a little bit of resistance, and we come back down into what? A fair value gap, right? We rebalance the leg inside the fair value gap right here. Then we displace higher. So you can literally just keep going down time frames. We go to the daily, right? What do we see? The weekly gaps here. We also have a daily fair value gap here as well, right? That the price come down, respected this and come higher. We actually inverse this to the downside, but we were due for a rebalance, and now it looks like we're going to all-time highs. All right, so on the daily time frame, what can you see? Price displaces, comes back down into the daily fair value gap. As you can see, hold up, just move this, comes back down into the daily fair value gap, respects, goes higher, takes out external. So you see how this goes up, back into an internal range, and takes out the external liquidity with this candle here. So external, internal, external, takes out external draws alongside the previous high. All right, so now you can see prices come back down into an internal liquidity, and this could now start to be forming a different trend, right? So you can see, if I just clear this, on the 4-hour time frame, we've taken out external liquidity. So this is so on this trend right here, we've taken out external, right? Not only we've taken external liquidity all here, right? Just here. Now, once price takes out external liquidity, say it to yourself, where does price want to go? Internal. So we can easily see price come back to this 4-hour fair value gap here. So we'll mark this gap out. So price can easily come down, internal, and we can either continue the trend for external and take out this external draw and keep taking out external draws. However, we could then, so I'll draw this out using this. We can come up to internal and we can, let's say, rebalance into an internal draw within that leg to continue external, internal, external, internal, external, all-time highs, right? So it's just going down time frames and seeing what we've swept. Have we swept a low? We want to rebalance, just like we went over in the Morrow board. So we'll go on to a 1-hour time frame and have a look how this works again. All right. So we'll just have a look inside this leg right here. So price at, for some reason, this is not working. We're on ES as well. Go on NQ. And it's loading. I think my trading view is a little bit bugged at the moment. All right, so we'll actually jump into the 1-hour time frame, and it makes it really easy to understand internal, external. So let's just go to here, and we'll go through this. We'll go through these legs right here. So as you can see, price comes back up into internal range. How do we know this? Because we come into this fair value gap. Do we respect this and keep going down and take external draws? No, we actually form a new trend. You can see we take internal, now we're back into internal range of this leg. All right, now after we take this internal liquidity, which is this fair value gap here, where do we go? External. All right, after we take external, what do? Come internal. There's a fair value gap right here. With this right here, we take the internal. What do? Take the external, take external liquidity. Once we take external liquidity, what do? Come back down into this fair value gap, which is internal. And what do? Take external. All right. It keeps going. It's just it's a pattern, right? Price now rebalances into this again, but we disrespect it, creates a new trend. What does it do? Come into internal liquidity. Then we go to external liquidity, right? You see how this works. Bang, up, external, right? And then we don't actually come back into this gap, but this right here would be a lower time frame internal rebalance. So let's find it. So at this leg right here, what do we rebalance into? I would say it's a 30-minute or a 15-minute, which we have. We have a 30-minute right here. As you can see, price takes that external and rebalances on this candle at 14.30 into internal and takes external. Okay? It just keeps going. That's all you have to see. Have we swept external and are we wanting to rebalance internally, or are we seeking external? So let's keep going. As you can see, takes external liquidity, right? Runs. It actually takes out more external liquidity to the left, takes this one out as well. Then what do we form? We form another fair value gap on the hourly time frame. What does price do? Comes back, rebalances into internal liquidity. What does it do? Take out external liquidity, right? Being this low at 1 a.m. So you can see how this works. Very clear. So we will now move on to some real time examples of actual how to take the trades pre-market and go through all that. All right, so this is going to be an example from New York AM session on Thursday last week. A super clean day, but it makes a lot of sense. And let's deep dive into it. So I'm going to start on the daily time frame, and it's pretty obvious what the daily time frame is doing. We are respecting a daily fair value gap to go up, to go higher. Okay, so we're displacing, we've retraced into this daily FEG and we are displacing back out. Okay, so that's on the daily. And as you can also see, we had a nice displacing candle, retrace a little bit. We have not made a lower low and we're displacing higher again. So very clear on the daily. Now let's go on the 4-hour time frame. What you want to look for is any 4-hour fair value gaps that are unfilled that price may want to sweep into before going higher. Okay, so you don't really worry about anything down here. It's really just what's in the actual leg. All right, so right here, we did actually have a 4-hour gap down here that's unfilled. We can mark that out. However, if we pull our retracement tool from here to here, we actually didn't come down to equilibrium, but we already had our retracement in price. So if we are bullish, we should technically not need to go back down here and go to the highs after that. We should just displace from here because we've had the retracement in price. So we're going to pick our draw on liquidity for this. Now, if you guys are wondering, this is just the most obvious draw ever. If you come over to here, we have stacked highs. So we have one high here, we have one high here, a high here, and a high here. When you have stacked liquidity with liquidity like this, even better. So that's our stacked liquidity. You can mark out all of them. I'll just probably mark out this one, or you can even mark out this one here. Okay, so bang, this is our draw. You can actually mark out this one as well because this is a 4-hour high. Now I go down on the 1-hour time frame, and you just want to make sure you have everything set up right. Now, coming into the market, you always want to make sure price shouldn't manipulate it into anywhere before going to the draw. So this 4-hour gap is definitely a manipulation spot. If the market did want to just open up and dump, then we should come and see this price before going higher. Okay, so I did have this marked out. There's nothing else on the 1-hour time frame. There's no gaps, nothing. So then we go on the 15-minute time frame. What do we see? Okay, we've taken out this low already. We have a 15-minute gap getting made here. That's really all, which should open up at 9:30. So this is our 15-minute fair value gap. Mark this out. Go down the 5-minute. So as you can see, we're just basically going down a telescope right now. We're starting on the high time frames and we're moving down onto lower time frames. So coming into the market open, we're 5 minutes out. What do we see? Down here, we actually have a couple 5-minute gaps down here. So bang. When gaps are like this, I do tend to mark them out together. However, we'll just mark them out separately just for this example. So that's this one here. We'll also mark this one out here. And for this, I also want to point out these two 5-minute gaps are equilibrium of this range. So if you mark out the equilibrium, you can see the 0.5 is perfectly dead center of a 5-minute gap, even better. So if I was looking at this, I would want this to get tagged on market open to go higher. Okay, because entering up here is just too much of a premium. Even if you're right on the draw, even if you're right on price coming up to these levels, you're probably going to get manipulated before going. So as you can see before, right, accumulation, right, and it's going to manipulate on open and distribute off the open. Right, so coming to the market open, let's have a look at this. This is our chart. Move this over here. Now, off the open, I just want to pull this back. As you can see, we pull straight away perfectly into that 0.5 equilibrium, which is also the 5-minute gap. So we have pulled back into a discounted point of range. We've also we've met our conditioning price, which is the 5-minute gap. Now all we're looking for is the displacement entry. So let's go through it. Step 1, right? Price is displacing towards our draw on liquidity, which is up here. Okay, we have our DOL, check. Price is displacing towards our draw. As you can see, check, right? We've got our retracement in price into our condition, and then we just wait for an IFEG or displacement. It's as simple as that. So right here, you could have had your entry off a 30-second IFEG. It's a really small IFEG here. Let's play this out here. So your entry could be up here. So what you do is put your entry here, your stop loss at the body low, and then your take profit can be that high. Now, if you don't want to hold for 94 points, you can simply just hold for a 1-to-1. You can hold for a 1.5, whatever you want to do. We'll just hold for the draw for this example. Now, this is going to be your first entry with the R8 model here. If you miss this entry, I'm going to show you the second entry. So let's play this out. Price displaces higher. Okay, takes the full draw. Now, I'm going to show you the next R8 model in this same sequence. So we take this draw. Yes, cool. This is our first trade. Now, just like the R8 model says, price is displacing towards a draw. Wait for the retracement, draw. Okay, so let's play this out. You can see how price is starting to stall. And what do we have in this sequence? Right here in front of you, we have a lot of fair value gaps. Now you might ask yourself, which one do we use? Are we using this fair value gap here? Are we using this fair value gap here? Right, there's plenty of them. Let's just mark them out. Now you have to ask yourself, you want to set yourself a condition. Do you think price is going to come all the way down to this one? Possibly. Okay, this is EQ of this whole range. It could, but when price is so bullish and draws are so close, let's go on the 30-minute time frame and have a look. See how close we are to these draws? It's probably not going to come down this far. It's not going to retrace 82 points when the draw is only 71 points away. So for this, my condition was any one of these gaps. Because if we kept displacing down here, I was like, maybe we're rejecting, we're coming back down to this low. So let's play this out a little bit. We don't get a retrace. All right. Now we get our retracement in price now. We don't get a retracement here, we get it here. Okay. Price displaces a bit, respects this gap, and it's coming back down. Now, from this point in price right here, I'm really looking for a continuation going up to the high from here, from this right here. Price comes, so displacing, retracement. We want to see this displace right now. We don't want to see this do this, chop around. We want this to displace in one candle. So a heavy displacing candle. So I'll play this out again. And you can see we get the displacement entry. You see how there's no wick? Even better. There is no sellers in the market when this close. Zero. You can put your stops at that low. You can target a 1-to-1. Okay. You can even just target that high, whatever you want to do. And then we can play this out. Okay. Full TP. So you can see before it took a little bit longer to get that retracement displacement model. So displacement, retracement, displacement, same thing. Displacement, retracement, displacement. That is literally all you're trading with this R8 model. So I'm going to find another example and bring you guys back. So we're going to get into another example here. We're going to also use our indicator for the sessions on this as well. So we'll turn this on. And if you need to get access to this, go to indicators, type in ICT kill zone to pivots and turn this on by trade for op. And this is going to load in. I put on the wrong one. So I need to put this one on here. Okay, so yours is going to look a bit more confusing. You can go through and copy my settings if you would like. So I'm just going to scroll through this. You can turn on and copy my settings and it's going to look like this. Cool. So coming into this trading session, this is a New York session as well. We can just mark out some of our levels. So coming into the day, I always start on the daily time frame. What are we doing? We are respecting this daily fair value gap, as you can see, to go higher. Okay, so initially I'm looking for these highs up here and this high and this external liquidity. Like we said before, internal, external liquidity. So we're looking for external liquidity, but this is a great example of how it doesn't always play out like this on the higher time frame, right? So we'll just mark this out. We know we're in the daily gap. So we're really looking for these highs. On the 4-hour time frame, do you see anything? Any unfilled gaps? No. Go down the 1-hour time frame. Any unfilled gaps on the 1-hour time frame? We can see we have an unfilled 1 hour. We can see we have an unfilled 1 hour up here. All right, that's pretty much all. Down onto the 30-minute time frame. 30-minute time frame has an unfilled gap here. All right, that's practically all. Go down on the 15-minute time frame. You see how we're just working our way down, right? Same thing, 15-minute time frame has an unfilled gap here. Now, we can get rid of this and we can basically use sessions as well. So as you can see, we have New York AM high up here. We also have London low down here and Asia low. Now, it's really important to see the scenarios built into this. So when you come into the session, you want to build out scenarios, okay? So we can either come down into this fair value gap, respect it and keep going higher, take out New York AM high, take out the gap high, take out London high. So this could be a scenario you could mark out, okay? Another scenario is we off open, don't tap into these gaps, come up, take some liquidity, and then come down, take up this liquidity. That's an option. And then there's also another option is we tap into this gap, right? We inverse this gap to the downside, respect it, rebalance into a 5-minute gap or 15 and keep going and take out these lows. So coming into the trading sessions, you can actually screenshot scenarios like this and put it onto like a journal before you trade. That's what I do in my Discord every single day. I put out like a screenshot like this and I say, rightio, this is what I'm looking for. So that's like pre-market situations as scenarios. So let's go on to the 1 minute time frame and go into this session. So this should be at 9:29, which is correct. And we know these are our unfilled gaps. So we know our scenarios as well. And we can just play this out. And as you can see, the session just absolutely dumps 100 points off the open. Now, I'm using this example because it's a great example to show you what happens with just a little bit of patience and when the market just dumps off the open with no entry, okay? When the market dumps like this, you want to wait for a 5-minute or 15-minute gap retrace. We know we've taken our draws. We know we've tapped into the 15-minute fair value gap, and you can see how we are completely disrespecting this gap. Now, at this point, you'd be like, okay, we probably don't need to go sweep New York AM high or this gap up here or London high. So now I'm automatically looking at London low and Asia low as our draw on liquidity. Just like before, I said session highs and lows, okay? We've already taken the gap. So basically, all you want to do is wait for at least a 5-minute gap to open up. Okay, so we'll skip this until we get a 5-minute gap. As you can see, we take London low as well, but now we have got a 5-minute gap that's opened up. Let's open this, and this is our 5-minute bearish fair value gap to use to respect to keep going down. So just like before, how we were saying external, internal, right? We just took out external liquidity. So what price wants to do is retrace into internal liquidity to take out external, and external being this low and Asia low as well. All right. So this is our trade. Now we wait for our 1-minute retracement into this 5-minute gap. As you can see, we get the retracement inside this fair value gap here, right? You can also draw out EQ of the range, all right? So just to see if we get another confluence to respect and keep going into this, which we don't, okay? This is our displacement entry here for the R8 model. If you want to take the inverse fair value gap, you could, okay? So we'll mark out this as well. So inside this trade, we have number 1, found DOL. Number 2, displacement to DOL. Number 3, wait for retracement, right? So we've waited for the retracement. And number 4 is wait for displacement out of FEG, which we have just gotten here. You can enter your short position here, stops at that high, 26-point stop, and target Asia low for 64 points. So let's play this out. Okay, and we tap into this fair value gap. You could go break even because this could respect and go higher. So you could go break even on this trade at that first point of possibly let's say the reversal point. If you have a point in a trade that could be the reversal point, like a fair value gap, you can go break even. And let's play it out again. So you wouldn't have got break even on this if you went break even at the gap. I would definitely be going break even at the external point. So number 5, break even at possible reversal point or external, right? External is this low right here of this leg, and we'll play it out again. So as you can see, you would have gone break even, but then you would have taken profit straight away. So this is the first trade of this kind of leg. Now, if you wanted to take the inversion, of course, the inversion's down here. There's just no really trade for this. You'd probably have to hold for 1-to-1, go break even at this low. And as you can see in this situation, it just doesn't play out. Price wants to come back up and retrace into internal draws. So just like before, I just want to point this out. See how the market takes external liquidity and seeks internal liquidity, being this 15-minute fair value gap, right? This is our 15-minute gap. And as you can see, price after taking external comes to internal. So then let's play this out and let's see, does price seek out external? So this is external, or does it keep rebalancing and going higher? So we'll play it out. So as you can see, it's now going to external of that leg, and we've gone to external. So displacement, retracement into internal, displacement to external. That's exactly how this market moves. So that's the second example. I think that goes over everything pretty well. And hopefully that makes a lot of sense to you guys. All right, guys. Well, that concludes the full R8 model breakdown of the continuation model that I use absolutely every single day coming into the market. So I hope you guys learned something from this video. And hopefully you guys enjoyed this like informative kind of type style video going through the charts and the Moro board, really deep diving, explaining into my trading model. And yeah, but that really concludes everything. So if you guys enjoyed it, make sure you give it a like. Go check my Instagram at NQ_James. Join the free Discord as well. And I'll see you guys in the next video. Peace out.